Hey, what's going on, y'all? I am on my way to check out, meet with contractor, meet with one of my business partners on a little house that we are renovating. On the meantime, I thought I'd take advantage of this time and talk to you about what's going on in the Albuquerque market with regards to real estate sales. I do, as many of you already know, I've got a property management company. I do a lot of multifamily apartment sales. We also have residential sales for listing and selling homes for our clients. You know, I've got a few brokers that work with us and such. And so I get asked questions about all kinds of different things. Owner financing, how's the market, how are interest rates? So here's the deal, all right? Let's tackle this. How are interest rates? That's a big deal. It's kind of part of the national conversation right now. Interest rates nationally have been high for a few years. So there's a couple things that cause that. Back in 2008, when the market crashed, the Federal Reserve stepped in to bail out. Government came up with these bailout schemes. And one of the things to boost the economy that they did was they lowered the federal Fed funds rate, the overnight Fed funds rate, which is the rate that when the Federal Reserve is going to raise and lower interest rates, that's the rate they're talking about. It's the interest rate that the Federal Reserve lends their money to banks. And it does not directly affect mortgage rates. However, there is another thing that the Federal Reserve does that doesn't get any of the news and any of the media, which is they call it quantitative easing and quantitative tightening. That's when the Federal Reserve actually steps into the bond market and they start buying mortgage-backed securities. And they issue billions of dollars every single month to buy mortgage-backed securities. Well, in a quantitative easing scenario, the Federal Reserve increases the number of bonds and the amount of money they're spending every month to buy those bonds. That directly impacts mortgage interest rates, 30-year mortgage interest rates, because they're buying mortgage-backed securities. Quantitative tightening is just the opposite of that. It's when the Federal Reserve realizes they've got too much money on the books, the economy is doing very well, and so, the economy is headed into a recession or something like that, and they want to avoid some of that, so they lower their interest rates and they start to sell those mortgage-backed securities. They don't renew the bonds each month, and they take assets off of their books. That's what happened in March of 2022. And as soon as the Federal Reserve announced that the quantitative tightening, interest rates shot up. They almost doubled in less than 6 months. Well, ever since then, the Federal Reserve has been in this tightening pattern. They stopped tightening late last year. When they stop tightening, that means that they're not buying and they're not selling. They're just kind of sitting, or they slowed down their tightening process, and they're not getting rid of as many of the bonds as they were. So that slowed down the rise in mortgage interest rates. That's a really long, complicated explanation, but the reality is that that's the number one factor that has affected long-term lending and long-term borrowing on mortgage interest rates. As the Federal Reserve starts lowering interest rates in the coming months, as we enter into the third quarter and fourth quarter of 2025, they met yesterday. They did not lower rates. However, there were two of the Fed chairmen that dissented. It was not a unanimous decision. They decided, there were two of them that said they wanted to go ahead and lower rates, and the others said, no, we're going to keep rates where they're at. The anticipation is we're getting close to our short-term borrowing interest rates getting reduced. That's going to be on your car loans, your credit cards, things like that. What we want to pay attention to for long-term rates is if the Federal Reserve decides to start a period of quantitative easing again, or if they will stop their quantitative tightening altogether. We need more money supply available for mortgage lending in order for those rates to drop. Okay, really complicated and short description of what goes on at the Federal Reserve level that helps us understand interest rates, borrowing, things like that. So we do anticipate that there is going to be some impact to long-term mortgage lending in the near future. We don't know exactly when that's going to be, but we're kind of anticipating towards the end of this year, early part of next year, we may start seeing interest rates trickling. We've been hovering between 6.5% to 7% for the last several months. The anticipation is that we may drop soon to kind of get down to the, lower sixes. And if the feds do decide to start buying mortgage-backed securities again with the quantitative easing, we will get into a period of lower interest rates again. We are starting to see some things that came out of Britain, out of the UK. Some of the lenders over there are actually lowering their interest rates into the threes to try to boost their economies. So we'll see what happens here in the United States, but all of those are positive things that are happening globally and locally as we start to get to that point. Okay, guys, I'm Joshua Christensen with Christensen Properties, and it's always my pleasure to serve you. Have a great day.